imagine this for a second. You're finally doing the responsible adult thing. You're investing money instead of just letting it sit in your bank account losing value to inflation. You open your investing app, type in S&P 500, and suddenly you see two things that look basically identical. An index fund. And an ETF. Same companies. Same market. Same low fees. One article says they're basically interchangeable. Another says ETFs are better. Someone on Reddit says it doesn't matter at all. So eventually you do what most people do. You pick one almost randomly and move on with your life. But here's the weird part. That small choice can quietly change how much money you keep over the next 20 or 30 years. Not because one magically earns higher returns. Not because one is secretly risky. Just because of taxes. And honestly, this is one of those investing details that sounds incredibly boring right up until you realize it can quietly cost people tens of thousands of dollars over time. The reason this confuses people is because index funds and ETFs really are extremely similar. They're both usually low cost. They're both diversified. They're both designed to track the market instead of trying to beat it. Which, by the way, is already smarter than what most investors do. So naturally people think, okay, same thing, different label. And in terms of what you actually own, that's mostly true. If both track the S&P 500, both own the same giant companies. Apple, Microsoft, Amazon, Google. You're getting basically the same market exposure either way. But underneath the surface, the structure is different. And that structure changes how taxes flow through the investment. The frustrating part is that almost nobody explains this clearly. Finance articles either oversimplify it into ETFs are more tax efficient, or they explain it with so much technical language that normal people mentally check out after 2 paragraphs. So let's actually make this understandable. Because once you see how it works, the difference suddenly feels obvious. Let's start simple. An index fund is usually a mutual fund that tracks an index. So if you buy an S&P 500 index fund, your money gets spread across 500 large companies automatically. You don't need to pick stocks. You don't need to guess winners. The fund just follows the market. An ETF, exchange-traded fund, often does the exact same thing. Same index. Same companies. Same investing philosophy, which raises the obvious question. If they're so similar, why do both even exist? Mostly because they were built differently. Traditional mutual funds came first. ETFs came later and solved some efficiency problems, especially around taxes. Here's where it gets interesting. Inside a mutual fund, money is constantly moving around. People buy in. People cash out. The fund sometimes has to sell underlying stocks to handle those transactions or rebalance the portfolio. And when stocks get sold for a profit, capital gains are created. Those gains eventually get distributed to shareholders, including shareholders who never sold anything themselves. That's the part that surprises people. You could literally buy a mutual fund, hold it quietly for years, never touch it once, and still receive a tax bill because other investors were moving money around inside the fund. Now ETFs work differently. They use something called an in-kind redemption process. The name sounds technical, but the concept is actually pretty simple. Instead of the ETF constantly selling stocks internally whenever investors leave, large institutions can exchange ETF shares directly for the underlying stocks themselves. That process allows the ETF to avoid realizing many taxable gains internally, which means fewer capital gains distributions get passed down to long-term investors. So imagine two people own investments tracking the exact same index for 20 years. One owns a traditional index mutual fund. One owns an ETF. Both experience the same market growth, but the ETF investor may quietly keep more money simply because fewer taxable events happened along the way. And honestly, this is why so many investors miss the importance of structure. Because visually, the investments look identical, but the plumbing underneath them is completely different. And here's where the real impact shows up. Compounding. People hear slightly better tax efficiency and assume we're talking about tiny amounts of money. But investing is basically a game of tiny percentages multiplied over absurdly long periods of time. Every dollar that leaves your portfolio early to pay avoidable taxes is a dollar that never gets the chance to compound for another 10, 20, or 30 years. That's where the gap starts getting bigger than people expect. Not overnight. Slowly. Quietly. Almost invisibly. Which is honestly how most real wealth building works. Now, extremely important caveat. This mainly matters inside taxable brokerage accounts. If your investments are sitting inside a 401k, Roth IRA, or traditional IRA, these distributions usually don't matter much because those accounts already have tax advantages built into them. Inside retirement accounts, the ETF advantage becomes way less important. But in a normal taxable investing account? Yeah. This stuff becomes very real, and it's one of the reasons ETFs became so popular over the last decade. Not because they were trendy. Not because they were exciting. Because they were simply more tax efficient. So what should you actually do with this? First, don't panic if you already own index mutual funds. They're still excellent investments. Seriously, the biggest wealth building factors are still investing consistently, keeping fees low, and staying invested for a long time. That matters far more than obsessing over tiny optimizations. But if you're choosing between an ETF and a mutual fund in a taxable account, the ETF is usually the more efficient option. Not because it'll make you rich overnight. Just because it tends to let you keep more of your own money over time. Also, make sure you're comparing similar investments. An S&P 500 ETF versus an S&P 500 index fund. Fair comparison. A low-cost ETF versus some expensive actively managed mutual fund. That's a completely different conversation. And one more thing people rarely mention. If selling your current mutual fund would trigger a huge tax bill right now, switching may not even be worth it. Sometimes the smartest move isn't perfectly optimizing everything. It's simply understanding how the system works so future decisions become smarter. The bigger lesson here isn't really ETFs good, mutual funds bad. It's that small structural details inside financial products can quietly change your financial outcome over time. Most people only focus on returns. But taxes matter, fees matter, structure matters. Not because one decision instantly changes your life, but because decades of small advantages compound into very large differences eventually. That's how investing usually works. Not through genius stock picks. Not through predicting the market. Just through consistently making slightly better decisions for a very long time. And once you understand the mechanics underneath investing, you stop blindly following advice and start understanding why certain choices actually make sense. That's the real advantage.